Right, so welcome guys. This is the first of 4 weeks, so we'll call this week one of basically taking data from the marketplace and doing a case study over the 4 weeks. So the real emphasis that this program's been ever since we started has been that we've got to embrace trading in everything that makes up trading, and that's in that a lot of people focus on the entry and believe they're looking for the perfect system with the perfect entry, and anyone successful trader will tell you entry is only a very small part. It's only one small step out of many steps, and actually it's one of the least significant steps out of all of them. What's more important, and what we've really focused on of recent times, is that you've got to have a very strong exit strategy. Stronger, or if the same, or if not stronger than your entry strategy. And more importantly, like any business, trading is all about having a system approach, obviously, but very well managed, and having every sort of area managed. Okay, so what we're going to do is over the next 4 weeks, and I've sort of got what we're going to cover over the 4 weeks just on the Word document here. But over the 4 weeks, we're going to take real information, real data, and present a bit of a case study. And from this, there'll be some really interesting findings. And any information, especially if it's real information, is I guess it provides the most relevance to what we're doing. It's not made up. We're taking real data, and we're going to skew it to make it work for us, and we're going to find some interesting things from that. So as far as the 4 weeks, just to sort of set it out tonight, week one, introduction to the case study. So I've got another document here which we'll go through just to sort of outline the parameters of it and what I've done. Just explain it all, set it all up. And then we'll get started with the data. So we'll just do the first month. So January this year, I've just got some net results. I'm not going to sort of take that data and do anything with it yet. I'm not going to do anything with the data until we get right to the end. But basically, I'll display the data for January. Straight up, you'll see some interesting things. And then next week, we'll take the data for the next sort of 4 or 5 months from February to June. Go through it again, just net data, net results, nothing too amazing yet. And then the third week, again, going through another 4 or 5 months, July to the present, just displaying the net data. And then the fourth week, this will be where it's really interesting. Sort of take that information or that raw data and then start putting it to use. Now, obviously, with this raw data, it can be used 1,000 different ways depending on the individual, depending on objectives, depending on personality, depending on what you want to do. So that's the great thing. It's raw data, and it can be molded to whichever way that suits you. But I'm going to take it and mold it to what I would do with it, or make it sort of relevant to us in the form of a bit of system creation, and really analyze those results, and do a few things like add in some indicators. I've got the automatic discretional indicators. I'll explain that later. But from that data, do a few extra things with it. But sort of week 4 will be really interesting, but I'll get to that when we get to it. I won't worry about that so much now. So tonight, just want to introduce you to the case study. So reason for the case study. So let me projection catch up. Now, a lot of stuff that's going to be said here too is going to have a sort of a personal twist or a personal opinion behind it. It's not always relevant to every person. And of course, what I say is not ever to be taken as the only way to approach it. It's certainly got my bias on it. But for me, obviously we talk a lot about within trading, there's sort of a real balance, or there's two ways to do trading, and that's discretional versus automatic, and then everything that's in between. Okay. The best approach is a bit of both, but I'm starting to lean towards becoming more automatic because of a lot of these reasons, and I'll sort of go through them now. But again, sort of up to the personal individual as to how discretional or how automatic you are. And I don't think there's any, of course there isn't a right answer to where you should be on that scale, if you can imagine it that way. But this is my perception of it, that success in trading is within the system management and the exits. So that's what we just spoke about. We've done many weeks now where we look at expectancy and showing your results in R multiples, or what we call R risk. And successful trading is taking the time and effort and putting putting a lot of effort into the management of a system, not so much the creation of a system or the entry of a system. Definitely not the case, but taking a system and really managing it very well. You look at any big business. We've said this a few times, but successful big businesses are businesses that are very well organized and very well managed. Okay, so some of the best businesses ideas in the world is a very simple concept. It's just done very well. I think the exact same thing can be applied to trading. It's not rocket science. We don't have to have a million rules and all these indicators, and sometimes the most simplest things are the best. And that's one of the greatest things I've discovered from this case study that we're going to go through is literally the simplest things are the most effective. Okay, so really put some emphasis on the system management and the exits. I'll get to that. Entries, and following on from that, the next point here, entries tend to be the focus. Like I said before, like any newer person, if you ever want to sell tickets to a seminar, people will focus on the entries. That's what gets bums on seats, but not necessarily the best thing for trading. In fact, if you read any sort of literature or any sort of talk to any successful person in trading, they'll tell you, it's not about the entry. And it's quite often the smallest contributor to success. Of course, it's important. Of course, it needs to spend a lot of time and effort on it, but it's a very small part of an overall picture. Okay. Third point there, more the market is traded through robots than humans physically being present and trading. Just meaning that, and sort of the next point as well, most systems have automatic triggers. There's all sorts of different systems out there. A lot of them have automatic triggers. So those 2 points, just making emphasis that it just seems that there's a lot of automatic trading systems out there, and there just seems to be more and more and more. Now, obviously, with some sort of discretion involved or some sort of way to keep on updating it and refining it and developing it, that's obviously going to be the best solution in any case. But I'm just finding, like I said right at the start, automatic can certainly have some advantages. And sort of the next point there, emotions and money don't mix well. If ever you start to go up the contracts, and you guys already would be starting to see it, the more money you start to trade, or the more pressure, or sort of the further you get involved, the more your emotions start to play. And that's where psychology and everything starts to come in. And if we can sort of really find something to work on that psychology or the emotional side of things, that's going to be really beneficial to trading. So this case study is going to look a lot into that. And back testing or forward testing is a vital key to success. So obviously, the more automatic it is, the easier it is to test. If I had to back test when I first started trading, I was so discretional. Like I said, there's nothing wrong with discretional, but I involved all the other markets. I did all these things. It was very sort of in the moment. And that's very, very hard to back test. And so for that reason, I started to simplify things a little bit more, so I could start to back test a bit more. But if you can't back test, you forward test. But again, I want to, within this case study, do something that we can very easily back test a long way, and sort of get some results, and get some results over many months. And it's not just about getting the results of one particular system, it's about getting results of a whole heap of things, a whole heap of data, and then sort of taking the best pieces of that data and creating the complete system with all the management in place, rather than just focusing on a entry. Okay, so the process, what we're going to do is starting from January this year to now, October 2012, we're going to take a static entry, so an entry that is fixed. However, that doesn't mean, so I've just got here, doesn't mean same entry applies forever. Testing and developing entries must remain active, meaning, one entry might work now, but it might not work in 6 months, and you sort of always got to be on the ball. And that's something David's very much about. I was listening to a video of his the other day, and one that he did recently for his for the auto trader that he's developing. He talks about, it's a lot of back testing. It's about finding what works, and finding what works basically over the last 9 months. Not that what works last week or sort of last 2 weeks. So you might have something that works, sort of this week, but that's it. It didn't work back a few months ago. But then you don't want something that worked 5 years ago either. You sort of want something that works over a longer period of time, but in the now, in the present. Okay, so but we're going to take static entries and many static entries. And those entries are going to be the first PowerPoint, sorry, the first power fade, the first PowerPoint, and the first terminator. Okay, so power fade is where you go through the PowerPoint and enter 3 ticks before it. PowerPoint is obviously looking to bounce off the PowerPoint. And then terminator is just the opposite. If you guys haven't heard that before, it's just the opposite to power fade. So where you look to go through the PowerPoint, you look for it to bounce off the PowerPoint, but 3 ticks away from it. So it's just a slightly, it's 3 ticks earlier than the PowerPoint. It might seem like not much difference to a PowerPoint, but it makes quite a difference actually when you test it. And with the point about these entries too, with the PowerPoint, sorry, the power fade and the terminator entry, it's not always the very first PowerPoint that you see, and I'll make sort of reference to this in later weeks when we pull up some charts, but it's not always the first PowerPoint that you see. Quite often there might have been an entry, if you're back testing quite often there was an entry, where it just didn't quite hit the PowerPoint, but you would have got your power fade or your terminator entry, and then it goes off. And so what I'm saying is it's don't just go to the first PowerPoint and go 3 ticks before that and that's your entry. Quite often there's an entry before that. And then the second power fade and the second terminator. As in, what that means is you must hit a PowerPoint. As soon as you hit the PowerPoint, take the very next power fade and terminator entry. And again, it's not necessarily always the second PowerPoint that you see as to where your entry is going to be. Do you guys know what I mean by that, or do you want me to do an example of what I mean now? You sort of just a quick yes or no? You on to what I'm talking about there, just as far as sort of elaborating what I'm talking about as far as an entry is concerned? Resume. Right, so I just got the charts up here. So example of what I mean is, okay, let's say for example, we're looking to take, the rule is we want to take the first power fade, okay, first power fade of the day. Okay, so straight away we go, okay, well obviously what that seems like it should be is look at the first PowerPoint that we can see on our chart, go back 3 ticks. So this is where our entry would be here, we're going long. Okay, that's not the first power fade of the day. The first power fade of the day is actually down here. Okay, if you were to go back and look at this market live, we opened up the markets here, it would have went down 1, 2, 3.5 points. Eric, there would have been a PowerPoint sitting here. Now you can see a PowerPoint entry, you go back 3 ticks, 1, 2, 3. Sorry, we're trading this live. We actually would have went short here. So the power fade would have been entered here, the first power fade of the day. Does that make sense? So yeah, I mean, a terminator. So let's, for example, let me just take my little pencil. So that's where the PowerPoint would have been sitting. We're going live. If we're going for a power fade, we enter short here, it gets stopped out. If we go on the terminator, now the terminator is PowerPoint, go back 3 ticks and buy. Look for the bounce off the area. So the terminator would have worked really well. Okay, but the fact is that there was a terminator power fade area here. Now obviously the first PowerPoint of the day, it literally has to hit the PowerPoint. So that's the first PowerPoint of the day. Okay, the same for the second PowerPoint of the day. Okay, so the rule is for our other entries is get a PowerPoint hit. So there it is there, hit one. Then we take the very next power fade and terminator. That's the data I'm collecting. Okay, so it looks like we go over here and here's the second PowerPoint. But the fact was, again, down here, there would have been another PowerPoint. You go down 1, 2, 3.5. So there actually would have been a PowerPoint sitting here. If we're watching this live, there would have been a PowerPoint here. The fact is it never actually touched it, so you don't see it. But there was definitely an entry here, a power fade entry and a terminator entry. So that's what I mean by just, if you back test, you just want to make it very clear that, you've got to really understand exactly the sort of entry you're looking for. Otherwise, you're going to get these very skewed results or wrong results. Okay, let me just get rid of that. All right, so I just want to make that clear. So again, the process, there's static entries. We're going to look at those particular entries over the next 10 months and what happens. But the exits are going to be very much, there's going to be many different exits, and we're going to take it and then with the raw data in the 4th week, create a system that would have worked over the last 10 months. or more importantly, a process. Because obviously we could take 10 months and go, okay, that's what happened. Let's create something that was profitable. That's easy. But we take a process and go, okay, these are the rules, exact rules. Then we go forwards and go, okay, as far as moving forwards, let's see what happens. And we've got an exact system or exact process, step by step. So that's what we're going to do. That's the process involved. Next, we want to create an exit strategy that suits external factors. It's vital that exit systems that you create, which creates, the reliability and expectancy. Okay, so obviously, depending on how big your exit is, you have a short exit, an easy exit, you're going to get high reliability or high strike rate, but your expectancy starts to drop. Or if you have a long stop loss or long profit target, you can have these big winning trades, but you're going to have less of them. Okay, so obviously your exit system is very much related to your reliability and expectancy of the system. But more importantly, when we start looking at the end result or sort of analyzing this data, you want to have something that meets your objectives. I've got objections there. Objectives and personality. So, it depends on the type. You might be someone that likes a lot of winning trades, but you're gonna have small winning trades. You might be someone else that, someone else might love. They're happy to deal with the losers. They don't mind losers, but they just want those big winning trades, which so they're prepared to go for big R multiples, but they're prepared to let a lot of losers go through to the keeper as well, so to speak. So again, it comes back to what's your objectives, what's your personality, and this is where at the end of the fourth week we sort of really start to tie in drawdown and all those sort of things, because again, you can have a profitable system, but unless you've got it all properly organised, managed, and drawdown all taken care of, and look at drawdown, if you don't manage that properly, you could actually have a system that is, yes, profitable, but actually blows up your account because you didn't have the contract sizing right or the position sizing correct. So that's sort of the exciting part we'll look at in the fourth week. Okay, so the stop loss exits, as in, if it's going to be a stop out, I've just kept this very simple, just a 5 tick automatically every time, 5 tick stop. Obviously this is an area that could be researched and developed. This is the sort of the one area that I haven't really taken and played with a few different things. I've had a 5 tick stop for a long time, and I think it's big enough to give it room, but it's small enough that you can have a heap of losses in a row and then also have some losses in a row and make it back. So I like 5 tick, but obviously again, you could really take that and play with a few different things. As far as take profit, I've kept it quite simple. I want a fixed. So with a 5 tick stop, we're going to test 5 tick exit or 5 tick profit, 8 tick profit, 10 tick profit, 12 tick profit, 15 tick profit, 24 tick profit. So that's a 6-point profit. And this is, so I got this inspiration from you, Kath, a trailing 16 tick exit. Where you just let it go and let the stop loss trail 4 points behind. Okay, so those exit, there's a lot of them, and you'll get some vastly different results. Obviously, a 5 tick or 8 tick profit target compared to a 15 or 24 tick profit target, it's very different. Again, sort of down this end, you're looking at more higher expectancy, lower reliability or lower strike rate. This end, you're looking at high strike rate, high reliability, and low expectancy or low R multiple trades. Okay, and then obviously these different areas, for one, suits different people, and two is suits different times of the market. So there's going to be times in the market where these work very well, the short stop or short profit targets, and then there's going to be times in the market when your big profit targets work well. But that's going to be sort of the trick, is finding a balance of that and something that works, and having sort of systems or indicators in place to go, okay, when do I apply the short stop or short profits, when do I apply the larger profits? And this is all stuff we'll start to deal with at the end of the case study. You guys got me so far? Just before I move on, just a quick yes, no, or you're seeing what I'm imagining? Good stuff. Cool. Wait, once we start going through the data, that's where it starts to get exciting, because it's amazing how some of the simplest things, like I said earlier, how simple things work well. And then as far as this is not now, but in the fourth week, system creation, some of the things that I've already looked at. which I'll show you guys in the fourth week, is sort of once we got all the data collated or collected, is start to add in automatic discretional indicators. That's a funny topic, but automatic discretional indicators, meaning I want to keep the indicators, I want to keep everything as automatic as possible, but it's quite discretional in that it's almost like applying a daily range indicator. You know, if you've got a certain daily range, then you go for a certain profit target. So you've got discretion in that way, going, okay, if we've got movement in the market, let's go for bigger targets. If it's a tighter market, let's go for tighter targets. But having automatic indicators to tell us when to do that. Okay. The next point, and this is one that's really important, and Kath, this is something that I think that you've really started to take on board, is blend multiple strategies and exits for better results and minimizing drawdowns. So taking multiple strategies, as in allowing half your contracts to go here and half your contracts to go there, or not just 2 systems, you might want 4 systems or 6 systems. You might have 30 contracts going here, 30 contracts going there, 30 contracts going here, but every time you go into the market, you sort of have 3 entries or 3 profit targets. I mean, you can do as much or as little as you want, but you blend the strategies to create better results, so physically better ticks more ticks at the end of the year, and most importantly, or what sort of excites me the most, is minimizing your drawdown. And I'll show you, even when we just bring up January's results, there's going to be some really good examples of this, and I sort of won't try to explain it now until we actually see the physical example, and this will make sense to you guys. And then third point there, as far as system creation is concerned, is refine and develop, and never be static. Test and measure. So, one thing might work fantastically now, but it's going to change and things will change. So always be a step in front of it and have some sort of indicator in place that once you start to get hit a certain number of times, then maybe the system has to change. But again, that sort of stuff we'll look at in the fourth week. But always refining and developing, never staying still, never staying static. We're dynamic traders. Even, or if you're automatic and you're automatic in approach, you still got to be quite dynamic. And then consider when we're creating a system, and again, sort of these 3 points here, you'll see especially these first 2 points, you'll see the relevance of these straight up when we start to go through the data in a minute, even just on January. But consider a few things. Consider the time of the year when you're trading or got an automatic system. So January and August, typically slow, low volume months. January, obviously, everyone's coming back from Christmas. August being the Northern Hemisphere summer break. And then typically March through to July tends to attract higher volume. It's the longest period of the year where they got no major break. It's sort of the time of year where everyone knuckles down and really gets involved with the market, and as a result, through those months you get higher volume. So that's when you expect to see, and this year has been a real typical year. January, February, August, very slow. March through to June, July was really quite active. So consider the time of the year. Second point there, consider previous action. So this is what I'm talking about before. Sort of, if you want to know when to go for more or go for less, we'll consider what type of market we're in. So you might have some sort of indicator that looks at the previous day. Okay, so the more volume the previous day, the more likely to get volume tomorrow. Look at the last 5 to 10 days. So if you just look at yesterday, well, maybe that's sort of a one-off, or something might have happened, or it might have been news. Look at last 5 to 10 days, they'll give you an average of what's happening right now. Or take it another step, look at the last 20, 50, 100 days to give you a real idea of what sort of the overall market's been doing over the last few months. You might look at each of those individually, you might look at a combination of those. We'll tie those in at the end. And the other thing too is consider stimulus. Other markets, as in what's sort of the world economy doing at the moment, events and news. So it's you can go back through news sites and see what days had major news announcements, and see if there's some sort of correlation between major news announcements in the market. So a major news announcement at 10 o'clock, and see if there's a correlation between that and movement within the market that day. So if you find that, you might also go, okay, as soon as there's a news announcement, let's go for a bigger profit target. That's just a real simple, quick example. Okay, so that's the boundaries, or that's the perimeters of what we want to do in regards to this case study. So let me bring up some data. Alright, so this is just January. So let me go back, notes. Just let me get project. Okay, I just want to make just a few of these points at the start. And what's really important about this is any sort of thing that you take on board, or anything that you want to research or do, always research and test it for yourself. Don't sort of rely on other people to do it for you, or rely on what someone else has said. Obviously you can do it yourself, or hire someone professional to do it for you that you can rely on, but just don't rely on another person. Sort of, if I was just to give you this information, one, you haven't done yourself, and two is you just don't know whether it's correct or not. Okay, so I just want to make that point first of all, and two is I just want to clear a few things here with regards to this data collection I've done for all these months, January through to October. Some points I want to make is that with a PowerPoint entry, you don't always get filled. Okay, so you might or you might not. Sometimes it physically has to go through the PowerPoint to get you filled. You guys have seen that with a PowerPoint entry. It's a limit order, so sometimes you get filled, sometimes you don't. So be aware that I've taken the entry as it is, but some of them might not get filled. In fact, probably about 1 in 5 entries are exactly right on the PowerPoint. So you've got to have some sort of way to make sure you do get filled, or prepared to not be filled and just let it go by. I mean, just keep that in mind. Okay. But power fade entries, I mean, obviously that's not a problem. As soon as it gets to the power fade entry is always entered through what we call a stop order, and you're guaranteed fill. So as soon as it hits your entry price, even when you're backtesting, you know it would have definitely been filled. Okay, so if limit orders or stop orders and how they work, if you're a bit unsure about that, I won't stop and sort of go on about now, but if you guys have any problems with that, just let me know and we can chat more about it. But I just want to make a few points here. Profit targets. Now, with profit targets, I made it that the price had to physically go through the target. So if I had a 8 tick target, I only counted trades that went 9 ticks or more. Okay, if it went 8 ticks, I didn't count it. Because with profit targets, it doesn't matter whether it's a power fade, PowerPoint, whatever trade it is, profit targets are always limit orders. So that means every single profit target was a limit order. So for that reason, I thought I'm not going to just muck around with that. I'm just going to make it that has to physically go through it. So that means a lot of my profit targets, some of them actually would have got there and been a winner, and I didn't count it as a winner when they were. So that's good. It's sort of working with the worst case scenario, this one. And then the other point is with before I got a few different exit targets. With the exit targets, the 5 tick exit target, I set break even at 4 ticks. The ones that go the exit target, profit targets from 8 to 15 ticks, so 8, 10 ticks, 12 ticks, 15 ticks, I had a break even of 8 ticks. And then the profit target of 24 ticks and the trailing profit, I had a break even of 12 ticks. Okay, so just a bit of a note there in regards to how I got the data. Righto, so here it is here. So you can see up the top, we got the first power fade, first PowerPoint, first terminator of the day. Then once we hit a PowerPoint, taking the next power fade, terminator. Okay, so that 5 entries, just sort of lay it all out. Then you got here a 5 tick profit target. If I just scroll down, 8 tick profit target, 10 tick profit target, 12 tick profit target. I know the projection's lagging a bit, but I'll slow down a sec. 15 tick profit target, 24 tick profit target, and then a trailing 16 tick profit target. Okay, and then got that for all the different months. So tonight I just want to go through January. And you'll notice just also for each of the columns, so you can see very clearly each of the columns for the different entries. But within each column, there's sort of two columns. Okay, so I've got the actual tick value on the left hand side, and the right hand side I've got the R value. Actually, I haven't taken the commission out of this one yet too. I will for the rest of them relay them in with commission taken out. So what I'd do there, I'd add on take a tick off every second and third trade. But anyway, the R value. So you guys know R value, so the risk. So for example, this very first one here, it's real simple. It's a 5-tick stop or a 5-tick profit, and there's a few 1-tickers going to be there somewhere as well, because obviously it went to 4 ticks, came back and got break even. So it's either 1 tick, 5-tick loss, 5-tick gain. So your R value is either going to be -1 risk or +1 risk. Okay. And with each of these different ones, you can see that there's quite a difference into what happened. So this one here was down 15 ticks. The next one was up 13 ticks. This one was up 21 ticks. This one down 15 ticks. This one down, this one up 21 ticks. Okay, so what I want to point out is something like this in a very tight market. I mean, personally, I wouldn't go for a 1-to-1 profit to loss ratio, but that's me personally. Other personalities might like that. But what I would say is this is January we're talking about now. Obviously, most years January is going to be very tight. Also, if you threw in there sort of a daily range indicator and did pick those tight ranging days, obviously this is going to perform better in January, or more potential to perform in January than days when the market moves around a lot more. Okay, and then sort of, actually no, yeah, so that's the point for that one there. So 8-tick, we're starting to get more into so 8 to 10 tick would suit me a little bit more. We're starting to get into more of a 2-to-1 sort of ratio. Okay, so this is exact same entries, just obviously the reliability and the expectancy changes, that's all. Different exits, obviously. Exact same entries, so the exact trades are exactly the same. It's just reliability, expectancy starts to change. Okay, so this one here, straight up, if you look at, so you can see the bottom of when I had a 5-tick profit target to compare it here. Okay, so this one was down 15 ticks. This one was up 3 ticks for the month. Okay, so less winning trades, reliability is lower, but expectancy is a lot higher because it's got bigger winning trades and it adds up, ends up getting a little bit of profit. Then if you sort of move along the different ones, you can see the best one here was the second Terminator, 42 ticks it was up. So that's all the 8-tick profits. I'll just quickly go through them now. So this is 10 ticks. Again, expectancy is increasing with every one of these, and reliability or strike rate is decreasing. Again, that second Terminator, it's doing quite well. And you can sort of see too, also obviously, for example, the first Power Fade and the first Terminator, they're completely opposing each other. When one you go long, the other one goes short. Same with the second Power Fade and the second Terminator. Whenever you get an entry for one, you take the other one exactly the opposite direction. There's no other way about it. So, for example, second Power Fade, second Terminator, you can see plus 55 for the Terminator, and then the Power Fade -5, the exact opposite of it, -5. And that's where, so this is where I talked about with you, Kath. I mean, hopefully, I think you already understood anyway, but when you take a blend of both, so you looked at, say if you're looking at the Power Fade, this particular month you would have got, you would have been down. The next month you might be up, who knows? But if you take a blend of the both, overall, you would have been up about 25 ticks. Okay, and then you look at that over all the months and see what would happen if you took a blend of the both. Okay, then obviously too, before we talked about drawdown, you're going to have less drawdown. So if you're taking half your contracts with the Power Fade, half your contracts with the Terminator, when you do win, your winners are only half the size. But the expectation is obviously having a go both ways. We're talking about automatic systems. Expectation is you're going to get some sort of win most of the time. So again, what's going to happen is expectancy per trade drops, but reliability increases. That's per trade. But in the longer run, what should actually happen technically, and you've got to test it, is expectancy should be the same. You should, at the end of the year, get the same result, but reliability should be a little bit high, and you shouldn't have as many losing trades in a row, and your drawdown periods should be smaller. You know, that's one of the main points I want you guys to get sort of straight away and see that. You know, it might be, I'm not sure. Do you guys sort of see what I'm saying there, or is it going to take a little bit more time to, a little bit more showing results and talking about that? Just give me a little yes or no. You get that? Does that, yeah, Eric, that makes sense? So especially drawdown, and this can be applied to obviously not just this, anything. When drawdown is one of the most important facets of trading. It's one of the things I spend most of my time with, and you can blend systems to really, at the end of the year, get a same result or a very similar result, but really start to knuckle down or sort of chop down your drawdown aspect of things. So that's a big thing that's sort of when you start looking at this, you start to realise that it doesn't look like there's many double losers. Yeah, I mean, Kath, at this stage, while we're up at the top here, we're looking at 5 tick, 8 tick, 10 tick. You know, we're getting bigger and bigger. So like I said, at the moment, right at the top, reliability strike rate's high, expectancy is low, and that's vice versa. As the lower we get, the higher expectancy gets per trade, but the lower the strike rate gets. But what obviously matters is the monthly strike rate, the monthly expectancy, or more importantly, the yearly strike rate and the yearly expectancy. Okay, so moving on, 12 ticks. So, and you can start to see some that perform more, that start to work a little bit more. And again, at different months, different areas will work quite well. If you're always taking the first PowerPoint or first PowerPoint area of the day, it's sometimes going to be a little choppy. By the time you get to the second PowerPoint area, it might start to smooth itself out. If I was going for trends and things like that, you'd want to look at maybe the second PowerPoint or something like that today, because let the market sort of chop itself out and then pick a trend. But it's just straight up. First of all, as far as the PowerPoint is concerned, the first PowerPoint of the day, you'll see not so much this month, but over 10 months. If all you did was take the first PowerPoint of the day and found an appropriate exit strategy, there's a ton of points to be made there. That's just taking the first PowerPoint of the day. But they'll start to become a little more obvious when we go through all the months of data. Then you throw in through areas where you go for more, and you apply those indicators of when to go for shorter stop or shorter profits and then longer profits. And that's what creating a complete dynamic system is all about. The next one, we're just getting bigger profit targets now, so we're getting up to 15. So again, there's starting to be a lot more red. But it really depends on the type of month. So obviously in January, what we're going to see is tighter month, January. So we should see up the top here, better results. And as we get lower and lower, a little bit, maybe the results won't be sort of as good, because January is always and typically a tight month. And this year was definitely the case. So sort of 8, 10, 12 tick profit targets should work quite well. As we get down here to 15 tick profits, you can see sort of some of its bigger losing months, negative 25 ticks there, negative 11 ticks there. So we didn't have anything like that up above, but that doesn't mean that it won't be the case. That might completely change or completely reverse when we get into these faster moving months. I mean, well, it does. I can tell you it does now. So that's where you've got to blend strategies together. Again, so this is a 24 tick profit target. So we've got a few negative 16, negative 28, plus 48. So look at that, massive difference. If you blended the two strategies together, you'd come out on top. And then this is the trailing stop. So they all got hit. So here we go, Kath. This one, obviously this is right down your alley, Kath. So that your second power fade, you looked at, you copped probably about that exactly, 6 point loss or something like that. But then if you took half the contracts in exactly the opposite way, because it's an automatic system, this is what we talked about. It's you don't have anything at the moment to tell you which way the market's going. So you're sort of leaving yourself a little bit exposed as all you're doing is going one way. So by going both ways, look at that, the Terminator actually did really well, made a ton of points. So you blend the two together and you actually would have been slightly up for the month rather than being 6 points down. Okay, so I just got a couple of questions there. So time of the year, we've sort of talked about this as we go along, and we can really start to get a clearer answer on this at the end of the data at the end of the third week. Once we've looked at all the data, or 10 months of data, which obviously then it's going to be a lot more relevant, put it in a lot more perspective when we see it over a longer period of time. We're only looking at a very small time frame at the moment, and we're looking at a very, probably one of the tougher months of the year, January. So time of the year, or is going to make a big difference to these systems. And when we start comparing these to, say, you compare this month to June or July, it's going to be a big difference. And then how a blend of the systems can get you results or different results and reduce your drawdown. So that's what we talked about before, and hopefully you can start to see very obvious now once we've seen some real life data. But anyway, guys, we'll leave it there. That's sort of the end of the first week. So what we've looked at there is obviously introduction to the case study and looked at January's data. So straight up already, and this is sort of just a very small snippet of the year, and I can tell you now, when we look at the rest of the year, it gets quite interesting and things completely change. One area that works now is completely different in another area, say in June and May when volume is quite different. So we'll continue to work our way through the data in week 2 and week 3 of this case study, and then we'll put it all together. That's sort of the exciting part, put it all together and make it work in week 4. Remembering that what it comes back to is your objectives, your personal objectives, and your personality. Okay, so I think with objectives, this particular style, you can make it work for you no matter what your objectives are. There's no problems there. Personality, that's a different thing. You've got to have something that you really have faith in, believe in, something that works for you. So I know this particular style is not for everyone, but what's important is you have something that works with your personality. But what's sort of the moral of this is that what really is king is system management, exits, and having a complete system, a complete structure in place that's been back tested, and really focus on the exits. Entries is certainly not everything. There's a lot more to trading than that. And even if you trade something else, certainly that hopefully you get some real good ideas, like taking blended strategies and things like that, but some really good ideas that will work for you. I know for me, once you start going through this data, ideas start popping up left, right, and center, and seeing things that work that you didn't believe could work. So it's sort of just taking that first step and then really discovering along the way. So that's what this is all about. Obviously, it's a case study. That's the objective or the goal of this, and we'll continue to go through it, and we'll come up with some fantastic information, data, and results all at the end. So I'll speak to you guys soon.